Hi there. Thanks for joining us here at PhillipCapital Market Watch. This is Li Rui, equity specialist from Phillip Investor Center. Today we will be discussing what to expect from weakening US dollar and how you can prepare for your investment denominated in US dollar. As the Fed monetary policy has wider effect on US dollar, let's summarize some of the key points addressed in the September Federal Open Market Committee FOMC meeting. To support the still fragile economy, Federal Reserve announced that they will maintain purchasing of treasuries and mortgage-backed securities at the same magnitude and pace. Federal Reserve also announced change of target average inflation rate to 2%, therefore allowing it to potentially stay above 2% for a period of time before considering a rate hike to control inflation. During September FOMC meeting, the Fed projected that the personal consumption expenditure inflation will only hit 2% in the year 2023. The Fed also projected that unemployment rate will only get back to the pre-pandemic level in 2023 at around 4%. As such, the close to zero federal funds rate is expected to hold out until 2023. With monetary easing ongoing, we expect more downside pressure on US dollar. This graph shows the weekly chart of the US dollar index. A higher index indicates a strong US dollar, while a lower index signals weakened US dollar. As we can see, the US dollar index had plunged 10% from its high since March amid easing monetary policy. With Fed's firm decision on interest rate, US dollar might continue to weaken in the last quarter of 2020 if there is no significant downside risk on risk assets such as stocks. As usually there is a US dollar demand surge during stock major sell-off event. US dollar index is currently supported at a support range bound between 92 to 94. In the case of index price broke below stated support level, US dollar index might continue its downside to test the next support level at 88.5, which is the low established in 2018. Actually, an adequate depreciation in US dollar currency could leave positive impact on United States economy, exports, and asset prices. First of all, a weakened US dollar would increase US exports due to attractive United States domestic goods as compared to foreign goods, which in turn reduces imports for foreign goods. As a result, it improves the current US trade deficit situation and was aligned with Trump's policy to shrink the trade gap. In addition, expensive foreign goods would impose cost-push inflation, while an increased domestic demand will impose demand-pull inflation, which collectively increase prices and the real gross domestic product. On the side note, with cheaper domestic goods, manufacturing companies may consider shifting their manufacturing bases domestically into the United States, which in turn creates jobs and reduces unemployment. Lastly, a higher export, higher inflation, and lesser domestic competition will provide tailwind for US assets such as stocks. However, a weakened US dollar might diminish foreign investors' return on US dollar denominated assets. Hence, it is vital to learn how you can get prepared for a weakened dollar. One way to mitigate the negative impact of a weakened US dollar is to diversify your US dollar investment in companies or sectors that could benefit from a weak dollar situation. Certainly, companies that have its business revenue derived substantially from overseas tend to benefit when the dollar slumps. This is due to a stronger foreign currency will inflate revenue when the revenue is to be converted into US dollar. Sectors like consumer staples, technology, and industrials derive more than 40% of their total revenue internationally. These are the sectors that have the highest overseas exposure and serve as a good pick amid weak US dollar conditions. On the side note, diversifying with the American depository receipt allows investors to shield themselves from negative US dollar impact, as when US dollar falls against ADR issuer home currency, ADR value rises in dollar term. However, the diversification has limited effect when ADR issuer home currency was pegged to US dollar, such as Hong Kong dollar. However, if you decide not to add additional companies in your portfolio, you may consider hedging the weakening US dollar with ETF. The Invesco DB US Dollar Index Bearish Fund aims to track the value of US dollar relative to other six currencies inversely with a relative factor close to 1. As implied from the graph, when US dollar index depreciates by 1%, UDN gains 1%. This is a relatively mild hedge against weakening US dollar as compared to opening a leveraged foreign exchange position. The ETF also helps achieve better correlation than gold, as gold inverse correlation with US dollar might not be intact under many circumstances. That's all for Philip Capital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Leave your comments. Thanks for joining us and see you soon.